Hello, all. We are jumping into chapter 17. It's going to be our last chapter we covered. We're only going to cover bits and pieces of it because it's kind of an interesting chapter. It is a chapter on, hey, here's a whole bunch of little tidbits that have to do with revenue recognition, different small scenarios that we haven't really focused on in the past. But really, when you see what they are, they're kind of principles of accounting level stuff, um, which I think is a nice kind of relaxing way to finish up this semester. Um, so you'll see down in my tabs here, they're all kind of different things, but they all have to do with revenue recognition. And these are the four topics we're going to cover in this final week. So the first one is what happens when you make a contract with a customer and then you modify it or you kind of add to it. Okay, what do you do journal wise? And you're going to see these and you're going to be like, I feel like I could have just put this together on my own. What's the point of this? And that's just how easy this material is, hopefully. You know, watch, I said that, and then in the discussion post, it'll be like a bloodbath of confusion. But let's see, I'll try and make it straightforward. So to talk about modified contracts, let's just look at the example I put up here. Smartwatch Inc. enters into a contract to sell 200 total watches to a customer on April 1st for $20,000. 100 watches will be delivered on April 30th and the next 100 on May 30th. Cash will be paid separately at the time of each delivery. Okay? So let's just stop right there first. So we're selling 200 total watches for $20,000 each, and it's going to be split up. 100 will be sold in April and 100 in May at whatever half the price is, $10,000. Okay? If we want to get a per watch price, so if I add this up here, per watch price, okay? Normally when you give a big contract 200 watches, you probably give a deal. So $20,000 total, it's not going to like that. $20,000 divided by 200 watches, we're looking at $100 per watch, okay? For a smartwatch, that's pretty good. So per watch price, $100 with the initial contract, okay? So, but then it says on May 1st, Smartwatch agrees to sell an additional 50 watches to the customer when it delivers them on May 30th for $150 a watch. This is the same as its standalone selling price. Put a pause there, pretend we didn't really see this. So let's say we hit April 30th, okay, back from the original. On April 30th, when we deliver 100 watches to a customer, okay, 100 watches at $100 each, so half the contract price. That's also when they're paying cash. We're going to debit cash, 10,000, and we're going to credit sales revenue, 10,000. All right, we're just dealing with the revenue side of things. Normally, we would tackle cost of goods sold and inventory since these are merchandise. Don't worry, we're just doing revenue stuff. So that's April 30th. You're probably looking at that saying, yeah, I know I would have done that. Right. But here's where things, they don't really get tricky. It's just a little extra to think about. Now it's May 1st, and Smartwatch agrees to sell an additional 50 watches to the customer when it delivers them on May 30th for $150 a watch. Okay? This is the same as a standalone selling price. So what this means is if when this company sells one watch to a customer, someone comes to their store and they buy one watch, they charge them $150. That's what the standalone selling price is. So this deal up here was a deal. Because it was a bulk purchase, they gave them $100 each. But now, for whatever reason, with these additional 50 that they're going to sell on top of the 100 they need to provide for May 30th, okay, they're selling them at their normal contract price. So what happens when you have a situation like this, when a contract is modified and the selling price is the same as the standalone selling price, you recognize two separate entries. So on May 30th, the first thing you would do is you would just do what you would have to do to finish up this top contract. Okay? So On April 30th, we already gave them 100 watches, recognized $10,000 in revenue. Now we would have to do the same for May 30th. Give them 100 watches, recognize $10,000 in revenue. So we would debit cash for 10,000, and we would credit sales revenue for 10,000. Okay, and in the notes now, this is kind of why it's going to help. We don't do this too often because it's kind of just an automated thing. But usually under journal entries, you put a little note. So this is 100 watches at $100 per watch on April 30th. You would make the same note for what we just did, 100 watches at $100 per watch. Okay, it's kind of showing where did this exact transaction come from? Why is it $10,000? But now, when we have that additional on May 30th, that we're going to give them 50 watches for $150 a watch, we now debit cash 50 watches times 150 each. So $7,500, and we're going to credit sales revenue $7,500. So even though these happen on May 30th and it's the same accounts being debited and credited, because the contract is modified and the selling price is the same as the standalone selling price, this is just one of GAP's silly, kind of unnecessary things, you have to make two separate entries. One for the original contract, 100 watches at $100 each, and then one for the new kind of modified edition, the 50 watches at $150 each, and you would say 50 watches at $150 per watch. Now, again, you're probably like, hey, that's kind of stupid that we have to separate it. We could just merge the journal entries. I know, I understand. It's just, this is more so, the journal entry isn't hard. It's just the rule GAP wants you to follow. So they're saying whenever the contract's modified and the new selling price for the modified aspect is the same as what the company's standalone selling price is, you have to recognize two separate entries. Okay? Now, say it's the same details as above, except on May 1st, the additional contract is for 50 watches at $75 each, which is less than its standalone selling price. So in this situation, when it's less than the standalone selling price, okay, when it's less than the standalone selling price, you can merge the entries, okay? So what this means is, same thing. So it's the same starting details, and then the only thing that changes is what happens on May 1st. So on April 30th, we would still debit cash, 10,000, and we would still credit sales revenue, 10,000. We would put a little note, 100 watches at $100 per watch. But now on May 30th, okay, what GAP says is when you modify the contract and you're not selling the new features, the new inventory items for the standalone selling price, you can merge the entries. So instead of doing two entries here, like we did, we're allowed to do just one entry. So one debit to cash, okay, and one credit to sales revenue. Now we're all smart. We could put the math together. But what we need to find out for our notes is what is the per watch price. So what this means is on May 30th, we're giving 100 watches, okay, at $100 per watch. So 100 watches at $100 each. So that total equals 100 times 100 for $10,000. And then we're also giving 50 watches at $75 each. So that's going to be 50 times 75, or $3,750. Okay, so the total is going to be $13,750. Okay, so this is the total cash that we're going to recognize on May 30th, 13,750 for sales revenue. And then in our notes, what we do is we say this is for 150 watches at, so what do we need to do? We need to find the new per watch price based on this total. So it's 150 total watches, 100 plus 50, and this is the total selling price. So 13,750 divided by 150, it's $91.67 a watch. So the big thing with this is kind of just identifying when you look at your journal entries, you know, when management looks to see how things are going, maybe your sales manager, they're seeing what are they getting per watch based on the sales. And this is how GAAP says you have to show it based on, is it the same as the standalone selling price? Again, the standalone selling price is the price you would sell one watch to a customer who walked in your store. So what's your normal sales price? If it's not the standalone selling price, when you modify the contract, you could join the journal entries together like this. You actually have to join the journal entries together like this. Okay? Again, easy journal entries, easy calculations. It's just a concept that maybe might be a little tricky. Okay? Now we're going to look at upfront fees. Okay? Upfront fees are, you know, when you pay for something and you have to give something up front, maybe a registration fee, maybe like a license fee, an initiation fee, something to like get your account set up. Generally, they're non-refundable. So generally, it's some type of startup fee when you first join or purchase something. So Brown's Gym receives a new client who pays $1,000 on January 1st to cover the whole year, and also has to pay a registration fee of $90 at the time of joining. Okay. Hey. Okay, I don't know if these numbers are accurate for Brown's Gym. I've never went there, but this is what we're dealing with. So you see what we have here, our new client pays $1,000 on January 1st to cover the whole year. Plus, they're paying a $90 registration fee at the time of joining. So what you would do here is first look at it. It's on January 1st. What's happening? A new customer is giving you cash to pay for their upcoming year worth of gym membership. Okay, so they're giving you cash now for something, for a revenue we haven't provided yet. So we can't recognize revenue. Okay, remember, accrual accounting only recognize revenue when it's earned. So what we would do is we would debit cash, because we're receiving cash, and we would credit, what's that account? Unearned revenue. Okay, that liability account that says we have to provide revenue. Okay, and what we would do in this situation is we could actually join them together. So the $1,000 for the gym membership and the $90 registration fee, we could debit cash for $1,090 and we could credit unearned revenue for $1,090. Right? Now what happens each month, so now January 31st, they have 31 days in January, sure. On January 31st, once 1 month has gone by and you recognize you're adjusting entries to recognize revenue, you debit unearned revenue, okay? And we're going to credit sales revenue. It might be more of a service. We'll say sales revenue. And we're only going to do it for 1 month. So what we have to do, since this was for the entire year, we're going to divide this total by 12. Okay, so we're going to do 1,090 divided by 12. Not divided by 1, divided by 12. Okay, and this is going to be the same. So now when we recognize our monthly revenue, we're going to recognize sales revenue not only for the $1,000 or the 1 month worth, but also for 1 month worth of the registration fee. So registration fees just get added to the sales revenue, okay? It doesn't have to go to a separate account. Same thing, any type of initiation fee, a startup fee you have to pay, or a company receives when a customer has to pay you, okay? Let's keep going. Next thing we're going to look at is commissions. So we have Cocoa Inc. I made this and I don't know what I'm saying. Cocoa Inc. makes sales directly to customers and also third parties who remit to them a commission. So commission is when other people sell goods for you and they pay you a bit of the profits they receive. Cocoa Inc. made a sale on April 1st directly to a customer for $2,000. On April 12th, a third party made a sale for $3,000 and remits a 20% commission to Cocoa Inc. So what would happen here? Well, April 1st should be easy. On April 1st, you have a debit cash. Again, always assume cash unless it says otherwise. So we debit cash. We're going to credit sales revenue for $2,000. So this is just a normal sale to a customer. The only thing that's new here is on April 12th, the third-party store or seller, when they sell our goods, they only give us a commission. So we're still going to debit cash, okay, because that's how we're assuming they're giving us our commission in cash. Generally, it's always cash. And we're going to credit specifically commission revenue. So we're identifying this revenue as commission revenue, okay? So sales revenue is when we sell the goods, credit commission revenue when someone else sells the goods for us and they only give us a commission. So the amount that we're going to recognize, the third party made a $3,000 sale, they only give us 20%, so it's going to be $3,000 times 20%, not 209%. No. That's some deal, huh? 20%. So $600. And that's it for commissions. You just recognize commission revenue. So again, nothing crazy hard in these. It's just, here's something else we've never really looked at. Kind of easy stuff, but stuff we didn't want to throw in Principles 1 to make anything else confusing. All right. So now the last topic that we are going to talk about. Give me 2 seconds. I'm going to find my notes that I made for this. Okay, is going to be considerations that you give to a customer, which are generally rebates. So rebates. You buy something, you get like a cash rebate, but you got to submit for it, so they make you work for it. I don't really get the purpose, but I guess it's kind of a deal, and they know people are lazy, and they probably generally won't go for the rebate. But say we have this scenario. Cranium Inc. offers $50 worth of rebates to customers when they make a $200 or greater purchase. Customer makes a $400 purchase. Let me add to this. The rebate is only good for, okay, this is just for this specific company. It could vary. 30 days after the sale is made. Okay, after that, it expires. Okay, and let's say the sale was made on April 1st. All right, so what would happen in this case? Okay, Cranium Inc. offers a $50 rebate when a customer makes a $200 greater purchase. This specific customer makes a $400 purchase. So on April 1st, we would debit cash. Again, we're assuming cash for everything, for $400. Now our credits, normally if there's no rebate, we would just credit sales revenue, $400. Okay. Now this customer does qualify for the potential to get the rebate because their purchase was greater than $200. So whenever a customer qualifies for a rebate, again, even though they have to work for the rebate, they have to send it in, we are going to credit a rebate liability account of $50. Okay, so this means we may have to pay them $50 back in the future. So $50 liability account, and then that means we can only recognize sales revenue of the difference, $350. Okay, so this is how GAAP says do rebates. Now, say there's really two outcomes that could come. Customer claims the rebate, and customer does not claim rebate. So if within the 30 days the customer makes a claim for the rebate, okay, they're going to get their $50. So journal entry is real easy. You got to get rid of the liability, rebate liability of $50, and you got to pay the customer cash. So we're going to credit cash of $50, and that's it. So that's what happens when a customer claims a rebate. But what happens if the customer doesn't claim it? Okay, we recognize this liability. It's past the 30 days. Now what do? Oh, good golly, oh gosh, nothing crazy. All we do is we get rid of the rebate liability, again, $50, and now we're allowed to put that towards sales revenue. So where initially we weren't allowed to recognize that as sales revenue because potentially we were going to have to give that money to the customer, since they don't claim their rebate, we just recognize sales revenue. Okay? Again, I don't think these 4 different topics, they're all unique for sure, and they all have their special rules, so it's a lot to remember. What do you do in this situation compared to this situation, compared to this, compared to that? But when you look at the journal entries, if you break it down one by one, it's really not crazy, okay? But still, ask the questions you have, no matter how big, how little, and we'll tackle it together, okay? This will be my last video for the semester because the week after next is finals, so it'll just be an assignment. But outside that, all the best, guys. Over and out.